Welcome back, everyone. You're watching John AG Expert. This morning in London, something important happened in the silver market that most people are completely missing. 1 month silver lease rates suddenly jumped to 6.3%. In simple terms, that's the cost someone must pay to borrow real physical silver from London vaults. And here's the key point. Lease rates don't jump like that when silver is easy to find. They spike when someone urgently needs real metal and the available supply is tight. At the exact same time, the paper market is telling a very different story. Paper silver is trading around $75 COMEX futures, dropped as low as $72.62 yesterday. So now we have two completely different signals. The paper market says silver is plentiful. The physical market says silver is getting tight in just 9 days, February 27th. We may find out which side is telling the truth. And there's another catalyst coming fast. In about 3 hours, the FOMC minutes will be released at 2 p.m. Eastern. Depending on what the Fed says, this whole situation could speed up quickly. But before we get ahead of ourselves, let's slow down and look at what the physical market is actually showing right now. Because almost nobody in mainstream coverage is talking about this. This is not a chart pattern. This is not a social media rumor. This is real pricing data coming directly from the London bullion market, the place where physical silver is actually borrowed and moved. As of this morning's London session, the 1 month silver lease rate is sitting at 6.3% annualized. That is a sharp move higher in a very short time. And remember, this is happening while futures prices are still suggesting silver is cheap and easy to get between $72 and $75. Before we go deeper, quick note, right now, about 75% of people watching are not subscribed. If you value this kind of boots, on-the-ground physical market insight, the kind that cuts through paper price noise, consider subscribing. This channel focuses on what real metal is doing, not hype and not guesswork. If you're locked in with this kind of analysis, drop John AG Expert in the comments so I know you're following closely. And if this style isn't for you, no problem at all. I'm here for the viewers who want to understand the difference between paper pricing and physical reality. Now, before we go further, we need to clear up something very important. Because most people have never even heard this term before, let's break down what silver lease rates actually are. So what exactly is a silver lease rate? And why does today's 6.3% reading matter so much? Think of it like this. When you borrow money from a bank, you pay interest. When traders or companies borrow physical silver bars, they pay a lease rate. It's simply the interest charged to borrow real metal. Now you might be wondering, who actually needs to borrow silver in the first place? There are several major players in this market, and all of them sometimes need access to physical bars sitting in London vaults. First, you have short sellers. These are traders who have sold silver contracts and may need to deliver real metal later. If they don't already have the silver, they must either buy it in the market or borrow it temporarily. Second, you have industrial users. Companies that make solar panels, electronics, medical devices, and other products use large amounts of silver. If they've promised future deliveries of their products but haven't secured the metal yet, they may need to borrow silver to keep production running smoothly. Third, there are arbitrage traders. These are sophisticated players who move silver between different markets. For example, from London to New York, to capture price differences. To do that quickly, they often borrow physical metal. And fourth, you have market makers and derivatives desks. These firms write options and structured products tied to silver. To manage their risk properly, they sometimes need to hedge with real physical metal, not just paper contracts. Here's the important part. All of these players need actual silver bars, not just futures contracts or paper exposure. And when plenty of metal is available, borrowing is cheap. Typically, in a relaxed market, silver lease rates sit somewhere around 1% to 2%. That tells you vault inventories are comfortable and lenders are happy to provide metal. But when lease rates jump to 6% or higher, the message changes completely. It means demand to borrow silver is rising. Available lendable supply is tightening. Vault operators know their inventory is becoming more valuable. In other words, the physical market is getting stressed. And that brings us back to today. A 6.3% lease rate is not normal background noise. It tells us that right now, in London, someone needs physical silver badly enough to pay a very high premium to get it. Vault holders aren't charging that rate by accident. They charge it because inventory is limited, demand is urgent, and replacement metal is not as easy to source. Now, to be clear, 6.3% is not the highest we've ever seen. During the October 2025 silver squeeze, lease rates briefly exploded above 10%. That was a true stress event in the physical market. At that time, a major driver was the rush to move silver from London to New York ahead of potential U.S. import tariffs. Everyone wanted metal at the same time, and borrowing became the bottleneck. After that episode, lease rates cooled back down into the 2% to 3% range. Markets stabilized, panic faded. But, and this is very important, the market never fully returned to the ultra-low lease rates we saw before the squeeze attempt. The floor moved higher, the structure of the market changed. And now, this morning, we've jumped back to 6.3%, which is getting uncomfortably close to the stress levels seen during last year's disruption. And the timing here is what really makes this interesting, because this spike is happening while COMEX registered silver sits near 102 million ounces. March open interest represents about 366 million ounces. And first notice, day is only 9 trading days away. That combination is why serious traders are paying attention. Lease rate spikes rarely happen in isolation. They usually appear when the physical market is feeling pressure, when someone needs metal quickly and can't get it easily. And right now, we're starting to see multiple signals lining up in the same direction. In the next phase, I'm going to walk you through the hard evidence that suggests the physical silver market may be tighter than the paper price is showing. Now let's look at the actual evidence, because one signal alone can be noise, but multiple signals pointing the same way start to tell a story. Right now, we have several independent data points suggesting the physical silver market is tighter than the paper price implies. Let's go step by step. Evidence number 1, lease rates at 6.3%. We already covered this, but it's worth repeating. This is documented London market data from this morning's session. The 6.3% one-month lease rate is elevated and signals strong demand to borrow real metal. On its own, that gets attention, but it doesn't stand alone. Evidence number 2, backwardation in the silver market. This one is extremely important. As of today, London spot silver has been trading above several COMEX futures contracts, including contracts months out. That condition is called backwardation. Here's the simple version. In a normal, well-supplied market, futures prices trade higher than spot prices. Why? Because holding metal over time costs money. Storage, insurance, financing. So normally you see spot price lower, near futures, higher, distant futures even higher. That's called contango, and it's what healthy supply usually looks like. But right now, in parts of the silver market, the curve is flipped. Spot is higher than futures. When that happens, the market is basically saying, we want metal now. Immediate delivery is more valuable than future delivery. That is not typical behavior in a loose market. Backwardation often appears when physical supply is tight, delivery demand is strong, or there is stress in the system. And importantly, silver has shown repeated backwardation signals since late 2025. That persistence matters. Evidence. Number 3, the $4.3 billion Wheaton deal. Yesterday, Wheaton Precious Metals made a massive move. The company committed $4.3 billion to secure long-term silver streaming rights from BHP's Antamina mine. We're talking about roughly 22.2 million ounces per year. Over 25 years, about 555 million ounces total. That is not small money. Large institutions don't lock in multi-billion-dollar supply deals if they believe silver is overpriced and plentiful. They do it when they believe long-term supply is valuable. Current prices are attractive, and securing metal early makes strategic sense. And remember, this deal was signed while silver futures were dipping toward $72.62. That timing is very telling. Evidence. Number 4, COMEX registered inventory. Now we move to the exchange data. Registered silver on COMEX, the metal actually available for delivery, is sitting near 102 million ounces. Back in October 2025, that number was about 167.7 million ounces. That's roughly a 39% drop. At the same time, March open interest represents about 366 million ounces of paper claims. That creates a paper-to-physical ratio of roughly 3.6 to 1. Now, to be fair, not every contract stands for delivery. Many get rolled forward. But when you combine declining registered inventory, elevated lease rates, persistent backwardation, and large institutional supply deals, the picture starts to get interesting. The growing disconnect. Here's the core issue the market is wrestling with. The paper market is pricing silver in the low to mid-70s, but the physical signals are flashing something different. Borrowing costs are rising. Immediate metal is commanding a premium. Institutions are locking in long-term supply. Exchange inventories have been trending lower. These two realities can diverge for a while, but historically, they don't stay disconnected forever. Eventually, one side adjusts. Either paper prices rise to reflect tighter physical conditions, or physical tightness eases and the stress signals fade. Right now, the market hasn't decided which path it will take, but the tension between paper and physical is clearly building. In the next phase, we'll break down who is likely borrowing silver at 6.3% and why they're willing to pay such a high rate. Now let's answer the big question. Who is actually borrowing silver at 6.3%? And why would anyone pay that much? There are four main groups that typically step into the lease market. Understanding their motives helps you see what might be driving today's spike. Category 1, short sellers under pressure. First up are traders who are short silver. If someone has sold silver futures or forward contracts, they may eventually need to deliver real metal. If they don't already own the bars, they have two choices: buy silver outright in the market or borrow silver temporarily and deliver it. Sometimes shorts choose to borrow because they believe prices will fall later. They hope to return the metal after buying it back cheaper. But here's the catch. At 6.3%, borrowing is expensive. No one pays that rate casually. If shorts are paying it, one of two things is usually true. They urgently need metal, or they believe covering at spot prices would be even worse. Either way, high lease rates increase the cost of staying short, which can pressure bearish positions over time. Category 2, industrial users securing supply. Next are the real-world silver consumers. Think about solar panel manufacturers, electronics producers, medical device companies. These businesses rely on steady silver supply to keep factories running. If they've already committed to future product deliveries but didn't fully lock in their metal needs, they may have to borrow silver to bridge the gap. For them, paying 6.3% may simply be the cost of keeping production on schedule. Defaulting on customer orders would be far more expensive. When industrial users step into the lease market aggressively, it often reflects tight near-term availability. Category 3, arbitrage traders moving metal. This group watches price differences between markets very closely. Right now, because of backwardation, there may be moments when London spot prices trade above COMEX futures. In that situation, an arbitrager might borrow silver in London, ship it to New York, deliver against futures, capture the spread. But remember, they must pay. The 6.3% lease rate, plus shipping, plus insurance, plus handling costs. For that trade to make sense, the price gap must be meaningful. So the fact that borrowing is happening at these elevated rates suggests the spread is wide enough to justify the expense. Another subtle sign of tightness in the system. Category 4, market makers hedging risk. Finally, there are derivatives, desks, and market makers. These firms write OTC options, structured products, complex silver-linked instruments. To manage their exposure properly, they sometimes need physical silver hedges, not just paper contracts. If their risk models call for real metal and vaults are only lending at 6.3%, they don't have much choice. They pay the rate, because the alternative is running unhedged risk, which can become very dangerous if the market moves quickly. The common thread. All four groups share one critical need. They require actual physical silver bars. Not ETFs, not futures exposure, not synthetic positions, a real metal sitting in vaults. And the fact that lenders are charging 6.3% tells us those vault holders believe their available supply is becoming more valuable. Why rising lease rates matter for price. Here's where things get interesting from a market mechanics standpoint. When lease rates rise, the cost of shorting silver rises too. Higher borrowing costs can lead to shorts reducing positions, shorts covering positions, or new shorts thinking twice before entering. And when shorts cover, they have to buy. Buying creates upward pressure on price. If prices start rising while borrowing remains expensive, you can get a feedback loop. Lease rates rise. Shorts feel pressure. Buying increases, prices move higher. More shorts get squeezed. We saw a version of this dynamic during the October 2025 move, when lease rates briefly pushed above 10% and silver rallied sharply in a short period. Now, to be clear, today's sound 6.3% is not at that extreme level yet, but the direction and timing are what traders are watching closely. Because we are now only 9 days away from first notice day, when some futures holders must decide whether to take delivery, roll forward, or close positions, and that ticking clock matters. Now, let's connect this setup to the next major catalyst on the calendar, the FOMC minutes release at 2 p.m. Eastern, because while the physical silver signals are already flashing, what the Fed says today could either speed things up or buy the market more time. These minutes come from the Fed's January 29th meeting, where officials kept interest rates unchanged in the 3.50% to 3.75% range. But the real question the market is asking is simple. Were policymakers leaning dovish, or were they still firmly hawkish? Let's walk through both scenarios and what each one could mean for silver. Scenario 1. If the minutes sound dovish, if the Fed discussion shows growing concern about the economy or hints toward future rate cuts, several things usually happen fast. Typically, you would see the dollar weaken, real yields fall, gold strengthen, silver strengthen. Why? Because lower rates reduce the opportunity cost of holding precious metals. Money tends to rotate back into hard assets. Now here's where it connects directly to the physical market. If silver starts moving higher on dovish signals, some traders holding March futures may decide not to roll forward. Instead, they may choose to stand for delivery. That matters a lot. More delivery demand would put additional pressure on the roughly 102 million ounces of registered COMEX silver. And if delivery pressure rises while lease rates are already elevated, borrowing costs could climb even further. In short, dovish Fed, potential accelerator. More delivery interest, grow tighter physical market. Tighter market, higher stress signals. Scenario 2, if the minutes sound hawkish. Now let's flip it. If the Fed minutes suggest officials want to keep rates higher for longer, the immediate reaction could look very different. You might see dollar strength pressure on gold, silver testing lower levels again. If that happens, some speculative longs could get nervous. Instead of standing for delivery, they might choose to roll their contracts forward to avoid near-term exposure. That would temporarily reduce delivery pressure on COMEX inventories. And if fewer players are scrambling for physical metal in the short term, lease rates could cool off from current levels. But, and this is critical, even in a hawkish scenario, the underlying physical signals don't just disappear overnight. Because remember, lease rates already spiked before the Fed. Minutes backwardation was already present. The $4.3 billion Wheaton deal already happened. Inventory levels are already where they are. In other words, the physical tightness story is not dependent on what the Fed says today. The Fed can influence timing and momentum, but it doesn't instantly create or fix physical supply. The key nuance most people miss. Many traders focus only on macro headlines, but what makes this moment interesting is that the physical market is already showing stress independent of Fed policy. That's important, because sometimes markets move not because of new information, but because existing pressure finally reaches a tipping point. Right now, we have elevated lease rates, persistent backwardation, declining registered inventory, large institutional supply locking. The Fed minutes could act like fuel on the fire, but the fire, at least based on current data, appears to already be burning. Why the next 9 days matter most. We are now inside a very tight window. Between now and February 27th, first notice day, the market will get real clarity on positioning. Key questions traders are watching. Will longs stand for delivery? Will shorts reduce exposure? Will lease rates continue rising? Will backwardation persist? The answers will start to emerge quickly. Let's finish by laying out the 9-day roadmap, because what happens between now and February 27th could tell us which side of the silver story is actually right. Right now, the market is at a crossroads. We have lease rates at 6.3%, clear signs of backwardation. COMEX registered silver near 102 million ounces. Open interest representing about 366 million ounces. And a major institutional player just locking in $4.3 billion worth of future supply. Those are hard data points. Now the clock is ticking. Today, Wednesday, February 18th. We already saw the lease rate spike this morning. The next immediate catalyst is the FOMC minutes at 2 p.m. Eastern. Expect volatility. Gold and silver could move sharply depending on whether the tone is dovish or hawkish. But remember, regardless of the initial reaction, the physical tightness signals we discussed are already in place. Thursday, February 19th. We get jobless claims in the morning. If today's Fed tone leans dovish and claims come in weak, the rate cut narrative could strengthen. That would typically support metals and potentially increase delivery interest. If claims remain strong and the Fed sounds firm, metals could face short-term pressure. But again, watch the physical signals more than the headlines. Friday, February 20th. 2 important developments, GDP revision and PMI data. Hong Kong markets reopen after Lunar New Year. This matters more than many people realize. Hong Kong often acts as an early read on Asian precious metals demand after holiday closures. If buyers step in quickly, it may signal strong regional appetite. If not, the market could get temporary breathing room. Monday, February 23rd. This is still a relatively quiet positioning day. Mainland China remains closed, so liquidity may stay somewhat thin. Traders will be adjusting exposure ahead of China's full return. Tuesday, February 24th. Major inflection point. Mainland China comes back online. This includes Shanghai Gold Exchange, Shanghai Futures, Exchange, Shanghai Stock Exchange. China left the market on February 13th with gold near $5,040, silver near $78. They're returning to a very different price environment. This is a key question the market is waiting to answer. Do Chinese buyers step in and buy the dip, or do they sell into the recent volatility? Their behavior could strongly influence near-term momentum. Wednesday, Thursday, February 25th at 26. These are the final positioning days before first notice. Watch open interest closely here. This is when the market starts revealing its hand. Key things to monitor. Are longs holding for delivery? Are they rolling forward to May? Are shorts reducing exposure? Are lease rates rising further or cooling off? Historically, these 2 days often bring sharp shifts in positioning. Friday, February 27th, first notice day. This is the moment of truth. We will see how many March contracts actually stand for delivery. At that point, COMEX must either deliver physical metal from registered inventory or settle positions financially. This is where the paper market meets physical reality, what we know versus what we don't. Let's be very clear and level-headed here. No one, including me, knows exactly what will happen on February 27th. Markets are complex. Positioning can change quickly. Lease rates can spike and then cool if demand eases. Backwardation can reverse if supply improves. The squeeze narrative can be delayed if most traders choose to roll forward instead of taking delivery. All of that is possible. But here are the facts on the table. Right now, we know lease rates just hit 6.3%. Backwardation is present. Registered inventory has fallen significantly from last year. A major institutional buyer just committed billions at current prices. Paper pricing still sits in the low to mid-70s. Those are objective data points, not hype, not rumors. Historically, when lease rates stay elevated and backwardation persists, the paper market often ends up adjusting higher over time. Why? Because physical metal is the real constraint. Physical is what must be delivered when contracts settle. Physical is what manufacturers actually need. Physical is what vaults are now charging more to lend. The bottom line, we are 9 days away from a key stress test for the silver market. The divergence between paper pricing and physical signals is clearly visible right now. Sooner or later, markets usually reconcile gaps like this. Either paper prices rise to reflect tighter physical conditions, or physical tightness fades and the warning signals cool down. The market will decide. Your job as an investor or trader is simple. Stay logical, watch the real data, avoid emotional decisions, and always do your own due diligence. Don't follow anyone blindly, including me. This is John AG Expert. Stay sharp, and I'll see you in the next update.